Welcome to Bitcoin Chats today, and I'll try and reveal the inner workings of Bitcoin and what's good and bad about it. So I'm Professor Paul Frijters of Academia Libera Mentis. I also have a visiting emeritus professorship at the London School of Economics, and all of this is on personal title. So what am I going to talk about? I'll first talk about what is a Bitcoin. Then I'll talk about a little bit about the bottom line. I'm an economist, so I follow the money. I ask myself who's winning, who's losing out of all this. And then I'm going to talk about Bitcoin magic, the things you've heard about: blockchains, wallets, keys, hashtag functions, mining, all that sort of stuff. And then the Bitcoin myths: trust, anarchy, overthrow of governments, green revolutions. What is a Bitcoin? Effectively, a Bitcoin is like an agreement that there is a Bitcoin. It's a bit like saying we agree there's a unicorn. And I own 10 unicorns, you own 15, and we both agree with this. And when we trade, I suddenly have 12 unicorns, and you've got 13. Bitcoin is no different. It is effectively an agreement between people that they exist, and they furthermore also agree with each other whether or not they've traded some with the others. And so it's very much like this particular PowerPoint slide. We can sort of all see it. We can all claim that it's mine or it's yours. But we can also have a system by which we recognize it's actually mine. And if you want it, you got to pay me for it. So it's very much also like non-physical assets, a whole world of internet images that you can trade as well by agreement. Now then the bottom line. Let's sort of count the money a little bit. Right? All existing Bitcoins in the world, and I just looked this morning, it was worth about 74,000 US dollars per single Bitcoin. Altogether, they're at the moment worth about $1.3 trillion, so $13 billion. That's only 1 in 300 of all dollars in terms of money going around in the world as a whole. The daily volume of Bitcoin trade, so how many Bitcoins are traded between people every day, is worth about $30 billion. Right? Most of that actually goes on stock exchanges like Coinbase, which is about 3/4 of the market. Now, almost none of that buys goods and services. So the Bitcoin fanaticists say, oh, this is money, it's digital money. Well, it's not used to buy things, right? It's basically traded. So it's very much like an asset. People gamble with it. That's nearly all of it. There was a country in South America which for a while sort of said this is legal tender, you can trade in it, but in reality they didn't, and they've just stopped doing so. So nearly all of the trades of Bitcoin, not all, but nearly all of them, go via these trading platforms. Coinbase is the big one. Then you've got Bitstamp, Kraken, and Bitfinex. Together, they're 99% of the trading platforms. And these are standard market platforms. You've got other platforms for shares, right? And so these happen to be for cryptos. You put in dollars, you get Bitcoins, you then buy and sell them with other people on that platform, and eventually you bow out and sell them again. Transaction fees. That's the big one. Right? Transaction fees, depending on how you trade, how you get in, how you get out, are between 0.5% to 4%. So if you tell your bank, look, I want so many Bitcoins and I want them at this price at that moment, then you're definitely going to be in the middle of that range. So if you do that 20 times, you lose half the dollars that you came in with just on trading. That's exactly the same with the stock exchange. You have some professional traders, of course, who have less commission. But mum and dad investors, they will be in that range. And that's the big game. Because, of course, if you have $30 billion in daily trade, well, what's 0.5% of $30 billion? That is $150 million. That is a lot. So every day, at least $150 million is just made in commissions. Right? And who makes the most commission? Well, Coinbase, of course. Coinbase is the casino where Bitcoins are traded most. And you can buy the casino. It is itself traded on the stock exchange. And you can buy it for about $45 billion as of this morning. So that's what the casino of Bitcoin is roughly speaking worth. So who's making money on Bitcoin? The mythology is, of course, this was a brilliant or lucky investor who 5 years ago bought it for nothing. And now they're laughing all the way to the bank. Well, in fact, it's the bank who's laughing most of all, right? Because they're now worth $45 billion, and show me the Bitcoin early investor who made that amount of money. So really the people who make money with it are the traders, the professionals around it, the people who are buying into it. Some of them get lucky, some of them lose their shit. And of course, Bitcoin being the success it was has been copied by a lot of other crypto coins, many of which have gone bankrupt, and very few of which actually made anybody an awful lot of money. Right? So sometimes the gambler wins, but the casino always wins. Let's then talk about Bitcoin magic, because it's very easy to get lost in the magic of the words that people use around Bitcoin. You know, Satoshi, money as memory, wallets, keys, blockchains, and mining. So I'm going to try and demystify these things by talking about it in the simplest possible terms, right? If you want to, as it were, know all the technical details, as I wanted to know, well, then you've got to wade through a lot of mathematical background. So first of all, crypto wallets and keys. What is a wallet? Well, this is a standard description of a wallet. A wallet is supposedly where you keep the Bitcoins. But really a wallet is something that you can advertise to the world as having a public key. You can see your wallet is a certain outcome, right? And you can announce it to the world. You can say to everybody in the world, look, I'm the wallet with, as the blue key, as the public key, something that everybody in the world can know is a particular outcome. And the outcome could be 40 numbers in a row, or it could be something else that's digitable. Right? And the key thing is that even though you can announce to the world your public key, there's only one private key that leads to that public key. And that sounds a bit weird. It's like basically saying, look, there's the door. It's got a lock. You can know everything about the lock that there is to know. Absolutely everything. And still, you'll never guess what the key is. You can never make the key yourself. And how does that go? That goes via hashing functions. But that is effectively what this whole business is. So you announce a door with a particular lock. And that lock, you say, okay, that's the blue thing. That's my public key is the particular lock. You know everything about it. And still, there's nobody in the world who can guess what actual key will unlock that door. But if you reveal your key, everybody can verify, oh yeah, that does open that door. And yes, oh, nothing else did. So you can prove yourself, right? The red one is the proving key of the blue one that you openly announce. And the wallet is then the place, basically the password, if you like, to which Bitcoins are sent and from which you can send Bitcoin, because you can prove it comes out of your wallet because you can regenerate the blue outcome. Right? So this is a very, very special lock. Only the private key opens it, coming to the public key. Now, in a normal lock of a normal door, if I tell you everything about the lock, all its intricacies, you can guess what the key looks like. Right? That's not true for this wallet, this cryptography system. This is also where a lot of Bitcoin originated from, cryptographers, people who are trying to send each other messages as secretly as possible in unbreakable codes. And what is the unbreakable code? Well, that lock is made up of hashing functions. Hashing functions are basically no more than a set of instructions. It's like saying, okay, you start with 5 letters, and the first thing you do, you turn them into numbers, and then you add 1,000, and you divide by 2, and then you sort of break it in half, and you put numbers under each other, and then you do, okay, the 4 numbers on top, 4 numbers at the bottom, and you add those up, and then you add some more zeros, etc., etc. It's basically a complicated set, but totally known set of instructions. Everybody knows the instructions. But the aspect of the hash key which is unusual is that from your private key out comes a very particular endpoint. And you can't go back. So everybody can follow the instructions from your private key to an outcome, would just be the public key, but there's no way that you'll be able to go back. So let me illustrate that, because that takes some getting used to. Right? Here is how it is described on the internet. This would be your public key. This is what you announce to the world. In this case, hence 40 letters and numbers. And you can sort of have many of them, but it's only one particular private key which leads to that. So if the private key is mouse, then you have a cryptographic hash function, and out comes this thing. But you can already see 40 numbers and letters. How the hell are you going to guess from that upwards somehow that putting in mouse would have gotten you that, right? Now, you can put in a whole phrase as well. It doesn't have to be as simple as that. A whole phrase, and then again the hash key, and you see that the outcome is very, very different, right? The blue mouse jumps over the green cat. You just change one little letter in that. So instead of over, you say our, and you get a totally different outcome, a totally different public key, right? And so you can really see that if you go back from that to get that is very different from going back to that to get that. So there's something very particular going on with this hash function. Now let me try and illustrate it to you as best you can, as best I can. So think of the hashing function as starting with your private key, that's supposedly mouse, right? And you're effectively on a leaf of a tree, right? Now, following the instructions, you go down to the stem of the tree and then you go down a layer, right? You go down a set of instructions and you arrive at a particular leaf of another tree. And you go down that tree again, you follow it downwards, you go to the stem and you get to a leaf of another tree. And you go down that and then you get to a leaf of another tree. And finally you get to the bottom of the stem and you get your public key. Now these instructions are dead easy to follow. Anybody can do it on a piece of paper. It's of course easier and quicker if you do it via computer. But anybody can follow those instructions. But what happens now if you try to follow the instructions upstream, right? So and that's where the layers come in. So if you follow this public key instructions upward, you get a gazillion leaves, right? And each of those leaves, if you sort of go up a whole layer of instruction, goes to a gazillion other trees. And the point is that nearly all of these other paths, so these other trees upwards, they're a dead end. They don't go to layer 4, right? You never arrive at the top layer where you could have a private key. So you've got something like 10 to the 10 or 10 to the 100, as it were, forests having here, and only one very particular path, right, via one of these many, many different trees and all the different leaves, gets you finally at a private key which works, right? And everybody can then verify it works. And that's hence the secret, right? The hashing function is very easy to follow in one direction, but basically impossible to follow the other direction. So you can announce to the world, I've got the wallet with that particular outcome, the 40 letters and numbers, and you can prove it to the world if they say, really, show this to me. You can show your private key, and indeed, your private key will lead to that, and nobody else has a real chance of sort of guessing it. Not even with supercomputers or quantum computers. They just don't have the computing power to go all the paths upwards. And so cryptography has the hashing functions as its core mechanism. And of course, in the real usage of these wallets, it's not just one key, but you often have 3 or 5. Because, as soon as you use a key, everybody knows it. So you can then got to supply the world with another set of keys and that sort of thing. But that's the principle of it, right? So these hashing functions move like going down a stacked set of trees. Now then the second bit of magic that you hear a lot when it comes to cryptography, in particular Bitcoin, which is blockchain, right? Now blockchain is effectively almost a social technology via which people come to a consensus as to what the group as a whole has said, right? So a blockchain is a little bit like having a group of people locked in a room who've got to expand on a story. And every 10 minutes, they got to add another word. And that room is then full of people and they all give another word. And it's got to add to the previous words that were in, as it were, a chain of words. So every 10 minutes, another word. So you can imagine after a whole day, you've got like 144 words or something like that, right? And so the blockchain is the surviving story. And the key to this is that if you force everybody to sort of give you another word, what emerges over time is, as it were, a central storyline, right? People have forgotten all the sort of side stories that people might have told or the words that some people might have used, which were not taken up by the others, right? Because you start to agree with the others on, as it were, what the previous 143 words were, and then on the 144th one, you can still digress, but you sort of get to a single storyline. And the single storyline is the blockchain. So if we try to illustrate that, suppose you are with 10 people and you're trying to decide on dinner, and dinner has got various aspects to it, and that your room is also full of chefs who sort of want to make that dinner, And, it's lucrative. You pay them basically to make the dinner, but they've still got to agree. And you have as a rule, okay, well, of those chefs who in the final round agree with the most others, we're going to allocate one of those chefs to actually make the dinner, right? Now, that gives them all an incentive to sort of agree with the previous line because they don't want to be the odd one out who says something totally different from the other chefs. And so they might start out, in the first round by some say pizza, then somebody says salad, but that's ignored. The fourth one says pizza again. And in the second round, everybody could say salad, but they're more likely to go with the central storyline. So they'll say pizza and then a second word. Pizza fungi, pizza pesto, pizza what? And here the fungi is sort of outvoted by the second round. Right? And so in the third round, the chefs would start with the first two that they sort of feel they've agreed upon. And sure, they could say salad fungi, but nobody else does that. So they'd be on their own and they'd have no chance of sort of winning the menu, as it were. So then they start again with pizza and the pesto and picanta or salami or whatever else it is. And that goes on and on and on. So if you think of this as blocks, you start with an initial word and then you add a second one and everybody in the room can shout different things. But because this is round by round and because you said, look, I'm going to give a prize to those who agree with others at the end of it, and then I'm going to choose somebody from those who agree with others, you're sort of forcing a little bit of consensus on this. Unless, of course, part of this blockchain, the people who do this, agree with each other to sort of corrupt the blockchain, for which you basically need more than half of the people in the room. Right? So that's miners and verification. So those proposing the next word in sort of Bitcoin blockchain terminology are the miners, and they're basically a computer. They're guessing, hence this overall story. And the blockchain works such that you effectively allocate nowadays half a Bitcoin to the winner, right? And the winner is one who's got the central group story, but also via the hashing function gets a certain number of zeros at the end. So furthermore, also has to randomize an awful lot. Right? So it's very difficult to corrupt this blockchain unless you have more than half of the miners and are cooperating with them. And of course, if you would have that, if you would have the computing power of more than half of all the people involved in the blockchain, you'd probably be quiet about it. So it's possible that the blockchain is entirely corrupted and we've never heard about it. Huh? So what are the issues with this, right? So the 10-minute delay, every, as it were, block takes 10 minutes for all the words to come out. And even for verification, lots of people sort of have, I want 6 blocks that have come in succession. So only after an hour am I going to acknowledge, as it were, the story of 6 blocks ago. Right? The 10-minute delay, up to an hour delay, makes this blockchain practically impossible to use for buying and selling stuff. I mean, imagine you're in the shop, you want to get out and say, oh, sorry, your verification will take 6 blocks, sir. It'll be an hour. There's no way you could do that. And so that's partly why blockchain technology is not actually used for transactions of goods and services, and why indeed most people even buy and sell blockchains instantaneously on a more normal stock exchange. Right? So the blockchain is more for the geeks and for the miners, right? And of course for these large platforms who themselves register their trades on the blockchain, but they don't really do them via the blockchain. So the vast majority of the Bitcoin transactions is not on this central blockchain at all, right? Coinbase or Bitstamps, these are effectively normal trading platforms, just as you would have if you'd go buy and sell in normal stocks, right? And so what you're effectively trading is not truly, as it were, the Bitcoins on the blockchain. It's more like, well, you're sort of trading the right, because Coinbase will then let the blockchain know that, oh, no, okay, an hour ago, you actually got more. Now, let's then talk about a thorny issue, the energy use of mining, right? Because as I've already said, these miners get rewarded for basically following the mainstream story. And part of the genius of the blockchain is that what these miners effectively do is the administration, right? These words are effectively all the trades that are recognized by everybody else on the blockchain. So if you like, the administration of the Bitcoins as to who owns how many and who is, of course, the wallets own how many is done via the miners. And so the miners are rewarded by doing, as it were, the administration in the same way as others, i.e. keeping the property right ledger going, right? Now, how many Bitcoins are given out are rewarded to the miners. So this is all in sort of the initial agreement on how to do blockchains and Bitcoins. Every day, about 450 new Bitcoins are created, right, by agreement of the entire setup. It's because there are 144 blocks, which is 24 hours, and 60 divided by 10 blocks per hour. So 6 blocks per hour over 24 is 144 blocks per day. And nowadays, you use, as it were, you get less Bitcoins per block than you used to, right? So you basically only now get half per block, getting that one right. So about 450 new ones. If you look at the current price, that means that on offer for the miners, the profit, if you like, for the miners is something like $30 million a day. Now, if you know something about economics, you know that, well, if the price of something is $30 million, how much would you be willing to spend in order to get that $30 million? Well, the standard answer is, well, the same. Right? In order to win $30 million, I'm willing to spend also $30 million. I'm not willing to spend $40 million or $20 million, but I'm willing to spend $30 million so that I'm just breaking even. And because the vast majority of the cost of this mining is not so much the computer chips, but the actual energy to clunk out all these guesses, right? Actually, the vast majority of the cost is energy usage itself. And so since the price is $30 million per day, that's roughly also the cost of the energy generated by the miners per day, right? Because that's basically what you have to pay in order to get in there, right? Now, of course, that is if somebody pays for the energy themselves. If they steal the energy, like if some sort of, young worker uses the electricity of his boss or steals it directly from the energy grid, well, then, of course, the actual cost of energy use is vastly bigger, right? Which is also why a lot of the miners are in places where there's very cheap electricity or it's easy to steal the electricity of someone else. Let's then talk about some Bitcoin myths, because people love, as it were, their societal dreams reflected in Bitcoins. No borders, no banks, right? Bitcoiners as the young leaders of an anarchist revolution. We all like the romanticism of this, or at least it appeals to me in principle to hear that kind of thing. The enthusiasm. We can do without governments, money without, right? What is true of that? Right? Well, I've already told you before that the people making money on Bitcoin are actually stockbrokers, casinos. So to destroy capitalism via a stock exchange is a very strange proposition to already start out with. But let's dig a little bit deeper and look at what for already 3 centuries we understood about money as its functions, right? Money is a means of transaction, so it has to be usable to buy stuff with it. And we already figured out that's not really happening with Bitcoin. It's more something to sort of speculate in. It's a store of value, right? So you can sort of have something now and pay stuff with it tomorrow. I guess Bitcoin is usable as that if you think somebody else will still want Bitcoins tomorrow. A unit of account that you think in terms of a particular form of money. We say, well, this costs so many dollars, or that costs so many euros. You could say this costs so many Bitcoins, this and that. It's not yet used as, but it could be. And a standard of deferred payment is basically saying, I owe you so many Bitcoins, so many dollars, right? So it's your debt whom you have in that. Now, this is actually a very difficult thing to understand, all these things. And almost no one understands it or its implications, right? And so you sort of have to do a master's in finance to do all that, but at least you can sort of already tick some of these boxes for Bitcoin, right? So for instance, if we talk about this means of transaction, we already know that Bitcoin can't use that. But also think about actually using Bitcoin for the means of transaction, right? World trade is growing. So suppose world trade would be bought and sold via Bitcoin. What happens then if trade grows? Well, you got the same number of Bitcoins via which you got to do more trade. Well, if Bitcoin is what you use for trade, what does that mean for the value of Bitcoin? It will go up over time. It will go up and up and up and up if it's actually used for trade, because trade goes up and up and up. The world gets bigger. There are more and more people around, right? In the economic sense. Now, suppose you've got a Bitcoin and you realize, its value is going to increase over time. Are you going to use it for trade or are you going to hang on to it? You're going to hang on to it. You're not going to use it for trade, hence, right? And so the fact that Bitcoin is by construction, there's only ever going to be 21 million of them, also means that by construction, it'll never be all that useful for a means of transaction, right? And this was figured out very early on. This is also why it's sort of been a failure as a means of transaction. So you should see Bitcoin in that sense, not as a form of money, but more as the other functions, an asset, something to gamble. Okay, right. Now then some myths, some things you hear a lot on the internet. One of the first myths is that Bitcoin is the first private money. If you look at Wikipedia, it sort of seems that that's what they think. That's not true at all. There are hundreds of private forms of money that the world has seen, even in the last couple of years, right? Just think of Facecoin, where Facebook tried to start another form of money, or the other cryptos that we've had. But you go back centuries and there were all kinds of things, right? So the East India Company had different coins for different trading areas. That's the British East India Company, the Dutch East India Company. In the 19th century, individual banks and large UK companies, they gave out their own coins. You go back further in history, the Hansa League in the Middle Ages, the early Middle Ages, they had their own coins. In Kenya, right now, mobile phone credit is used as money. So people send each other mobile phone credit to sort of, pay bills. And basically any form of private credit, such as air miles or research budgets, anything that you can send to other people or receive from other people can also be seen as private forms of money. As I've just said, Facebook tried Facecoin, and there are all kinds of large corporations and institutions which bring out private money all the time. This is not true at all. There have been hundreds of forms of private money, right? Bitcoin is nowhere near the first, nor is it truly used to buy and sell stuff. Whereas all these other ones, they were actually used to buy and sell stuff. That was their main function. So whilst Bitcoin were a gambling asset, actual private forms of money are very, very normal, right? And you can even see government money as effectively a particular private company, namely a government, giving it out, forcing people to use it, because government can say, look, I'm going to pay my workers in this, and I'm going to collect my taxes in this, so it can force you to use it. But a government has means of violence. It has an army, it has a police. And so you can see government also as a private form of money, but just backed up by the power of the state. Right. Now, what about the second myth? Bitcoin is better because it is in fixed supply. That is a very strange argument to make, because the world over the last 2-3 centuries has gone away from fixed supply money, like gold or silver, and has gone to what is known as fiat money, trust money. Money given out by governments who can create more, or private banks who can create more of it. Right? So this is true of the US dollars. It can just be created by the Federal Reserve, the same for euros. Right? So fixed supply disqualifies something as a use of money via the logic I've just already told you, that increasing trade basically needs increasing money in order to facilitate the trade. Otherwise, the money increases in value and people don't use it anymore. Right? So fixed supply is not a plus. It kills you off as a potential form of money. Right? And so this is why Bitcoin is not considered money by most authorities, and why it's also in the future pretty much unusable actually as money. Right? It's the same for using, as it were, famous paintings as a form of money. Right? If they're in fixed supply, you can't. You can use it as an asset, but that's it. Now, myth 3. Bitcoin will overthrow governments, right? This is very, very weird, right? But the idea is that if people all use Bitcoin as money, which is already hence impossible, they would lose trust in the money of a government and governments would collapse. Well, first of all, it's a very strange idea. This is a good thing to hope for, rather than sort of, the terrible political chaos you would get if this worked. But you also misunderstand the basic economics of a government. A government is someone who can force you to do things. It's got a monopoly of violence in an area. It can force you to use something as money because it can pay all its workers in it, can pay all the welfare recipients in it, it can pay for all the goods and services in the country with their own money, and it can force you to use it as well by saying you must pay your taxes in our money. That happens in the US with dollars. It happens in most of Europe with euros. And if you can't do that as a government, if you can't force people to use your money, you're not a government to start out with. So governments still having the tools of violence at their disposal are never threatened by Bitcoin. Right? Bitcoin won't threaten them because Bitcoin can't be forced on people as long as they're not truly backed by a government. Right? Now, myth 4 is that you can trust the blockchain, trust all these miners, because the argument goes, well, you don't know who they are, you don't know where they are. So they'll never organize so that more than half the miners would cooperate and sort of steal the Bitcoins. This is a very strange argument, right? Just think of this logic in a different environment. Do you trust a group of people you've never met, who don't have a headquarters, who don't have an obvious joint interest in something, just because they all have a computer somewhere and work with each other on the internet doing some protocols? Does that make them trustworthy? It's a very strange notion of trust. It's basically the same as saying, I trust all Thai restaurants in the world. There's lots of them. You find them in every city. And instead of a Thai restaurant, you can think of, the Bitcoin miners. And then you say, well, they would never get together to sort of be corrupt and steal money from me. Well, if all the Thai restaurants could get together and if there'd be a lot of money to be made, would I trust the Thai restaurant owners? Or would I think, well, probably they'll form a secret society of Thai restaurant owners to sort of come and steal from me? You would start to think that, wouldn't you? So the notion that you can trust blockchain effectively because you don't know who the miners are is very strange. And indeed, if you look at groups of miners, there are a couple of countries where the vast majority of the miners are, and they're actually rather well known. So then we arrive at the question, well, okay, if Bitcoin is sort of allowed by some countries, and they're not allowed by all countries, so I can already say that China does not allow Bitcoin trading to happen on its territory, right? Why does the US allow it, which is so important in the financial world? And the answer is rather simple. Most of the Bitcoins are traded on US platforms. We've already talked about Coinbase, which is about 75% of the market. It's worth something like 45 billion, traded on regular stock markets. And this is part of the US financial establishment. Right? Coinbase backers reportedly supported Trump's election by something like $50 million. Could have been a lot more as well, depending on which source you look at. Right? And of course, a private company like that is not an anarchist dream. Right? These are people who are solidly with the financial and political elites of the US, making them a lot of money, making US shareholders a lot of money. So of course the US allows it. It's their smart financial traders who are getting rich out of this. Why does China not do the same? Well, China did have a few Bitcoin trading platforms, namely in Hong Kong, but conveniently they got hacked, right? Now, you need to have rather a lot of sort of hacking knowledge to do it. And so Bitfinex got hacked in 2016, Biloxi in 2021, and effectively a lot of the Bitcoin got stolen out of these regular trading platforms. And who was the beneficiary of that? These American stock trading companies. And there are also some in Europe. That's rather convenient, right? As it were, the competition is sort of taken out. That was there in Hong Kong. But of course, the Chinese authority, no longer having Hong Kong as a large base where they are traded, no longer saw their own population getting rich via, as it were, the Bitcoin trade, and they just outlawed the whole thing. They thought, well, we're not going to have our population be fleeced by the Americans. So that tells you a little bit about the background politics of blockchain and crypto in general. So the bottom line on Bitcoin, you should see this as a form of gambling. Right? The smart people are the people who organize the casino, the people who organize the buying and selling of Bitcoins on the trading platforms. They're the smart people. They make the millions, they make the billions. The saps, the dumbos, they're the ones actually buying a Bitcoin, often, with their pocket money or maybe their father's money, right? And they dream of making it big. They've all got a story. My auntie Isa, she made $1 million by investing quick, many years ago. And well, there certainly are some stories like that. But of course, nobody tells you about how they lost half the family fortune by buying and selling and buying and selling and buying and selling and paying commission all the time. Nobody really owns up to that. Right? And so the smart people who make the money are the ones who organize the trade. And then in come the saps who sort of do the actual trades and usually lose at least the commission. A few get lucky, but on average, of course, you don't. Right? And smart governments then look at, okay, so who are the big guns here? Are they my people or someone else's people? And the US has obviously decided, the smart ones are my people. They're the ones making the money. So all power to them. And we're even going to support them with government money. And the Chinese have worked out, oh, it's not our people who are making money out of this. We're going to outlaw it. We're going to protect our population from what is effectively a sort of a casino scam. Now, blockchain itself as a technology has been, as it were, pushed up to be, all promising and this and that. But the reality of blockchain is it's very cumbersome. All this 10 minutes or a whole hour delay makes it very inefficient. And this notion of you should trust people you don't know who are totally distributed over the world, nobody really trusts that to any great degree. And so blockchain has not actually been used, or if it's been used, totally in a different way from the way that blockchain was envisaged initially for Bitcoin. So it's often just a marketing gimmick. They say blockchain secured, by which they mean that the same data is maybe in 10 different places in the world. And well, there's always somebody who would believe that. And previously, we would just say, look, we've got copies elsewhere. And now you say blockchain secured. Look, there's always a dumber who falls for it. So have we seen this before in history? Oh, yes, many times. The world of financial corruption and scam is sort of beautiful. There's all kinds of things. My favorite story for what is very much like Bitcoin is gold fever in the end of the 19th century. There were these places in the world, in America, Canada, but also in Australia, where they found gold. And all these gold diggers came and they all dreamed of making it big. They would find the big lump of gold. And they always found somebody to put in the newspapers who indeed got rich by finding a big lump of gold. And look at all these diggers, right? And sort of working very hard. But do you know who's actually making money? Do you think these were the ones making money? No. The people making money were the ones who were selling them. The pans, the shovels, and particularly who were giving them credit and who would then take the land on which they would actually discover any gold. So it was actually the bankers and the mining companies who actually made money out of this, not the individual, as it were, gold diggers. But of course, the gold diggers were the masses, dreaming of making it big by just being intrepid and going out there. And they all had a story of the people who made it rich was the reality of them. Well, many died poor and of diseases. And the people truly making money of them were the people organizing the whole gold business. So at its very core, Bitcoin trading is the smart people who are taking money from your pocket while you're mesmerized by the magic of wallets, hashing functions. Oh, this is so cool. I'm going to make it big and I'm going to smash capitalism at the same time. Really? You think the stock markets are like that? So this is the guy you want to be. If you're in Bitcoin, you want to be organizing the trades. You want to be setting up the trading platforms, being friends with the politicians, sort of benefiting them, they're benefiting you. And here's the one on their mobile phone. She thinks she can make it rich quick, and she's got no idea what goes on, but she loves all this sort of wallet stuff and is mesmerized by it. She's basically spending her money on that. There are two famous sayings in finance, and they very much go for Bitcoin. A fool and his money are soon parted. Well, we're modern nowadays. We don't say a fool and his money are soon parted. We say a fool and his or her money are soon parted. And a very old economic saying is, gambling is a tax on stupidity. The casino wins, not the gambler. Thank you very much.